viewers and investors, welcome to another episode of Outlook Money Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Mutual Fund. Today's topic of discussion is navigating market volatility with ETFs. I am Kundan Kishore, editor, Outlook Money, your host for this session, and I am delighted to welcome Mr. Chintan Haria, Head Product Development and Strategy, ICICI Prudential Mutual Fund, and Mr. Abhishek Mehrotra, Head Investment Products with HDFC Securities. Right. We just want to give you a short introduction of our speakers today. Mr. Haria has been associated with ICICI Prudential Mutual Fund for more than 15 years now. He is someone who drives new and existing products at the AMC. He is also a mentor at Atal Incubation Center at Narsi Monji Institute of Management Studies, Mumbai. Mr. Mehrotra has nearly 2 decades of work experience spanning from wealth management, banking, insurance to broking and distribution. He has worked with HSBC Bank, HDFC Bank, Reliance Capital, and ICICI Prudential Life Insurance Company in previous assignments. So welcome, Mr. Chintan and Mr. Abhishek.
Thank you. Always a pleasure, Kundanji.
Welcome, sir.
Pleasure.
Yes, sir. So first of all, I would like to ask you, Abhishek, sir, for a while now, the Indian stock market has been very volatile. Could you please help our viewers to understand what is the underlying cause of this?
So look, equity market, though in long run follow earnings growth, but in short run, it remains volatile due to continuous news flows, which keeps on coming up. You can make out recent news like a policy change, macro data which comes up, political development which happens, corporate governance issues which keeps on coming up, or corporate earnings. So these are the internal things which affect. We are also affected by a lot of external things like central bank policies, reopening of economies. You must be aware that China is opening up.
Right.
Commodity price movement, geopolitical issues, supply chain issues, inflation, growth. So all these things keeps on impacting day-to-day activity which is happening in the market. And that's the reason. In fact, if you see our macroeconomic outlook continues to remain challenging, in fact, for this year. Because inflation, though it is receding a bit, but still is higher than most of the central bank target. So this change or this impact or this market movement volatility is something which we have to live with probably for this year, at least for sure. So that is how the market is currently.
So basically, you mean to say that volatility is likely to continue this year?
Definitely, it will be part of life because the news reactions and the impact has been aggravated. Like the news flow, you can see the kind of the speed with which the news flows across. We have recently seen what has happened to Adani as an impact. I'm not commenting on the stock, but just the kind of impact what happens whenever there is a news change. In fact, interrelated news is like a better payroll data comes up and the people expect that the interest rate will continue to be hiked by the central government. So all these things, these data keeps on coming up, these news keeps on coming up, and it's daily, day in, day out impacting markets. So this volatility is part of our market and will live for long. So there's no end to that.
So if this will live for long, then what investors should do now?
So look, investor has to really diversify himself and reduce down his leverage. These are the best things which he can do. Now, when I say diversification, I just refer to the recent discussion which we were having, that 90% of the people who are trading in FNO have lost their money.
Yes.
So investor has to actually go through his risk profiling. He need to understand how he should balance, what is his asset allocation. Once he comes up to his asset allocation, he has to improve his skills about stocks or mutual fund analysis, or he has to rely on on liable sources like us as a broking house, or there are multiple research houses which are there. Individuals should avoid taking large weights in a single stock or a single theme. That is also what history has proved. In fact, some stocks which we have seen have been very volatile of late. In fact, some themes, just to give you example, in 2021, IT was the theme which was performing great, but 2022 was complete washout. So if somebody has a very heavy weight on IT, looking at the past performance, probably he may not be happy with the kind of returns which he would have got, or probably it would have been negative returns. The IT index was down. So what I mean to say is he has to reduce down his weights on individual stocks and themes. He has to take expert advice, keep funds for emergency, and keep on taking profits whenever there are. Especially when you are investing into stocks, unlike in mutual fund where the fund manager himself does this job. For equity or single stock positions, one has to keep on realizing what stock is giving up. Lastly, he has to obviously see the tax implication, because that's something which affect everybody's net results or net take home. So tax is something which is the last thing. But yes, investor has to be really very cautious in these days in terms of how he's participating, and spread across his money across asset classes, so that he is going on the right track. There is some money for equities. There has to be some money for mutual funds, ETFs, and various other investments like fixed income products.
Right.
That's how one can easily sail through.
So basically, you mean to say that diversification and asset allocation is the key for this navigating volatility.
Definitely, that's the way to deal with this market.
Here, Chintan sir, I would like to ask you, since you are one of the biggest fund house in terms of ETF, so could you please tell our viewers, can ETFs help investors navigating this volatility?
So if we look at the first question itself as to why the volatility is there, while
Right.
the real, let's say the shorter duration reasons or the short-term reasons were mentioned by Abhishek Bhai, if we look at the longer-term reasons why volatility may continue for the next year or so, or maybe even 24 months, is because we were in a low interest rate environment from 2015 to 2020. In fact, from 2008 itself, the interest rates were coming down. And when interest rates were coming down, the world was taking the advantage of asset prices going up. Now, interest rates after the inflation scare of 2021-22 have gone up globally and in India. And global inflation rates going up from being negative to say positive 3, 4, 5% means that there is going to be some change in the way the world functions. The world was used to a very low interest rate. Now the world will have to be digesting the normalized interest rates, if I can use that term. And that means that when this change or the shift is happening, which is after 15 years, there is going to be volatility for the next 1 or 2 years for sure. Now, the good part is India does not get impacted as much because we never had low interest rates or 0% interest rates, and inflation in India is pretty much controlled. Is in control thanks to we having our own energy. So that's there. On your second part of the question, as far as ETFs are concerned, clearly the last 6 to 7 years of growth in ETFs in terms of the number of offerings that the investor has, the choice of offerings that the investor has have expanded. And you were mentioning, Abhishek Bhai was mentioning about the importance of asset allocation, and you were basically reiterating the fact that if you want to navigate through this volatility, asset allocation is going to be of utmost importance. The good news is that now with all the offerings that are there in ETFs, you can create an absolute wide multi-asset portfolio within the ETF space. Earlier, you were restricted to probably having the large cap ETFs only in your portfolio. Now you have large cap, mid cap, small cap ETFs. You have, apart from that, sectoral ETFs also. And most importantly, the smart beta ETFs also are there. So the low volatility ETF is one prime example how you can basically have a portfolio created of low volatile stocks, which can help you create a long-term position in equity markets in low volatile stocks to tide through this volatility and basically gain the advantage. You have gold and silver also as options. You have debt funds also as options. So if you basically educate yourself, and that's the whole objective of this conversation, there are opportunities all around, there are options all around, and you can make a balance. Now, each individual, the balance is going to be different. What is true for me may not be true for my real brother, right? I mean, I could have 100% in equity, he may not, because his circumstances are different. So each one of you needs to have a financial advisor. I think that's where Abhishek Bhai and his team will be very useful in terms of guiding you what should be your asset allocation based on your risk profile. But as far as ETFs are concerned, we have ETFs across the board in terms of large cap, mid cap, small cap. The sectors, the prominent sectors in India, which is banking, technology, pharmaceutical, auto, infrastructure, all these options are also available for you. Financial services, we recently launched That is also an option which is available in terms of ETF, and the smart beta versions, be it value, which is the NV20, the quality, the low vol, all of it is there for you to basically participate in. Thank you.
So, sir, these are the products. But here I would like to ask you if you can just explain what should be the strategy that one can use to reduce the volatility and use this product.
Sure. So the first point is the volatility reduces with your investment time horizon, right? So while you cannot control the prices for the next 6 months, what one can be probably assured of or have seen in the past is that if you have a time horizon of 5 years, 10 years, and I think Abhishek Bhai was also mentioning that in the long run, that's where you will make money if you patiently invest and remain invested. And that's where the first strategy is that you should invest in equities only that part of money which you are not going to see for the next 5 to 10 years. If you have an investment horizon of less than 5 years, investing in debt markets which are yielding good returns is also a good option. Target maturity date funds, GSEC yields are reasonably large or reasonably big right now, I should say, for you to take advantage of higher debt returns as well. If you have more than 5 years, clearly the GDP growth, along with the GDP, the sales growth of companies, the profitability of companies, and the market cap of companies follows. So in the long run, the trajectory of the markets is what you need to capture. And that's where the strategy should be, whatever money I have for the long run, I invest in equity markets in a systematic manner. So you spread your investments over the next 12 to 24 months. And if there is a big drawdown or a big correction in the markets, you can add more at that point of time. So over the next 24 months, build a portfolio of the savings that you have and continue the habit of incrementally investing in diversified ETFs. Sectoral ETFs need a bit more expertise. So there, I think the expertise of Abhishek and his team will be very useful. But in terms of diversified funds, it will be very good if you can actually spread it over the next 2 years and have a patience for the next 5 years. That's the only strategy. It's very simple. It's not a complex formula for you to bother about. Thank you.
But sir, I've said, sir, just to simplify the whole thing, actually, we just wanted to understand, or if you can just help our viewers understand, of course, asset allocation is one part of the strategy,
right.
investing strategy. So please explain us this asset allocation should be according to the changing market condition, your age, or what are the factors one should consider while doing this asset allocation? या फिर market condition हो या फिर personal life goal हो,
Look,
how this should happen?
Yeah, I understood your question. So look, now we are into an age where everybody is living longer. So probably when I don't buy that philosophy that by 60 you have to put a lot of money into debt, because the age actually starts post 60 with a lot of spendings going up. And normally in India, people are living at the age up to around 80. So you have 20 more years to go. So yes, but one has to look at what is his overall asset allocation currently. And look, there's no age factor as such, how much you have to participate. One has to see what is his goals, how much he already has. So take, for example, if my goal is to achieve, say, 10 crores and I have 1 crore. So obviously I have to take a little aggressive bet in terms of my expectation and then the time in hand. But if I already have, say, 8 crores and my goal is to sustain this, probably I can work around with hardly any equity and play, participate into debt market products which are available. So first of all, one has to see what is his goal, how much he wants to look forward for, how much risk he wants to take, and he's okay to take, because risk and reward goes hand in hand, and it's a double-edged sword. So the more risk you take, the rewards can be that rewarding, and at times it can be that hurting also. So one has to really understand the risk and reward ratio before participating into any asset class for that matter. And third is time horizon. If the time horizon is long, a lot of asset classes fall in line in terms of a regular progressive, because there's no linear way of money to grow into equity markets. It will be volatile, and because of the factors which you have mentioned. But definitely, if you see in long run, the equity market trajectory has followed the profitability trajectory. And if you believe that the corporates, which is like, if you talk about Nifty, which is almost 60% of the broader corporate profits, it will continue to grow, and that's how one has to allocate. Now, again, going back to the same question, at such age, if somebody is really asking me in terms of somebody 60, 30 or 40 or 50, to that extent, I'll probably suggest him to go in the ratio of say 90, 80, and 70 in terms of equities, looking at the long-term horizon which somebody has. Of if somebody is retiring on 60 and then he has a corpus and then he has to distribute, obviously he has to look forward for his cash flows, which can only come through debt. He should not rely on equity for cash flows. Obviously equity stocks he can buy, and the dividend yields are low, so if its dividend is sufficing his money, his cash flow need, then to that extent it's fine. But then returns has to be mitigated in terms of what do you expect out of your portfolio, and that's how you have to do the entire spread of asset allocation between equity, debt, commodities. In fact, global equities also, which Chintan was checking, like sharing, like US NASDAQ is also there on the platform. In fact, Hang Seng is also there. So these opportunities are there across. So one has to need to quantify what he's looking forward for out of his investment, the time in hand, the risk he's ready to take on the both sides. So risk and return goes hand in hand, and then probably spread across his portfolio.
But if you could elaborate a little bit on this, asset allocation with ETFs, how one can do it?
Asset allocation through ETF is now possible to a very large extent because we have all categories of ETF available. So if I have to do the asset allocation across 4 parameters. First is Indian equities. In Indian equities, we have large caps, then we have mid caps, then we have small caps. ETFs are available for all these 3 asset class, all these 3 market capitalizations.
Right.
And then there are theme-based ETFs also, as Chintan was sharing, smart beta or low volatility on that. So that's one segment. Second, we come to the commodity segment. Obviously, it will not be a larger portion, but yes, it requires some allocation because that's a hedge against inflation, and it will be a cushioning part to your overall portfolio, where gold and silver ETFs are available. Third is your debt portion, where the likes of Bharat Bond or long-term gilt funds or liquid funds are available in the ETF form. So that's the third asset class where one can participate through ETFs. Fourth is the international ETFs, where you can buy US NASDAQ 100 or Hang Seng. In fact, through our platform Global Investing, we expose them to whatever ETFs are listed in US, so that if somebody is really bullish on China and he wants to buy China ETF, there are opportunities like that. But for an Indian investor, you have global equities, you have Indian equities, you have debt, you have commodities, which is covering a majority of the asset allocation one needs to do. And all this is really handy, really liquid. So one doesn't have to think about, the liquidity and other concerns regarding legal or other thing, apart from tax, and doesn't have to think about even storage. But tax is one thing which one has to identify how his tax will pan out depending on the spread which he wants take.
Chintan sir, as Abhishek sir rightly mentioned that one can do complete asset allocation with the help of ETFs. बट एक जो सबसे इम्पोर्टेंट होता है जो एक रिटेल इन्वेस्टर्स के लिए जो कि दे टिपिकली इन्वेस्ट रेगुलर मनी थ्रू SIP रूट, राइट? सो दैट इज अनदर वे टू नेविगेट दिस वोलेटिलिटी, राइट? रेगुलर इन्वेस्टिंग. So is SIP possible through ETFs? If you could just elaborate.
So I think from a investment standpoint, when we earn every month, save every month, and we invest every month, clearly SIPs have shown and proven to be a great long-term investment for the investors, and ETFs also do provide something called as a stock equity plan. I probably request Abhishek bhai, if you want to highlight on your platform how it works and make it demystify for the investors, please. Abhishek bhai, over to you. Thank you.
Sure. So the simple way of as normally we do an equity SIP. In fact, ETF SIP is also possible. SIP basically is a multiple tranches of investment of a defined amount over a defined period. That's basically what is an SIP is. So you are buying even if an investor has identified few ETFs, if you want to buy, say Nifty 50, so he can go on our website. In terms of stocks, he has to identify, because why in terms of stocks category? Because this is again a listed, we are talking about a listed instrument. So he can identify, say ICICI Prudential Nifty 50 Fund ETF, and then he can define his tenure and the amount contribution he wants to do. In fact, we have seen a lot of change over the period of time, where investors have become so much savvy that they are doing weekly or daily buying in these ETF as a product. Because
Right.
the good part is there is no other way where you can buy an index. If you are doing an FNO, obviously the maths changes everything changes. It's a rollover kind of a thing which you have to do. But if you want to buy India as a strategy, so these can be done simply by buying buying index. And buying index, the simplest way is to go through ETFs and buy that. You can buy daily, weekly, monthly, in fact every 3 months. So that totally depends on the investor's outlook and how much he wants to contribute. But these are facilities available on a platform, through mobile app and on a web platform of HDFC Securities, where a client can easily transact them.
So, Chintan sir, if you can just highlight what should be the current strategy, what should be investment strategy in this current market scenario?
So from an investment strategy perspective, we know that the world in the last 1.5 years has kind of gone into a higher interest rate environment where our expectation of asset prices should be low. In other words, we should not expect high valuations at high interest rates. And that is what we have to digest even in terms of our expectation of equity returns. The last 2.5 years, starting March 2020 to maybe October 21, was extremely high return environment in the world when we bounce back from COVID. Last 15 or 18 months, we are consolidating as a country. And maybe next 1.5 years, we'll keep consolidating. What we believe is, for example, as an investor, every second or every month, you'll not be able to change your strategy. So your strategy should be simple. Whatever savings you have, you decide how much you want to put in equity, how much of that you want in debt. There are asset allocation plans which you can asset allocation plan which can be created for you by your relationship manager, and then you continue with that asset allocation plan and change it only when there is a big movement in the markets. So as an investment strategy, to put it very simply, have a long-term horizon when it comes to equity investments. Today, luckily, debt investments are also giving higher yield, and then gold and silver as part of the portfolio, which is limited portfolio, can always be a part. Investment strategy should not keep changing with the changing environment. As Abhishek Bhai was mentioning, many people invested in tech in 2021, 2020 because that was the flavor of the season. Don't go by herd mentality, because herd mentality always hurts, but have a simple systematic plan with which you can create a long-term portfolio and don't have too many, let's say, ETFs or too many stocks in your portfolio if you are a stock investor. Have a limited number of ETFs which are good enough for you to create your long-term wealth, and then keep building on them even every time you get an opportunity when the market's correct. And I think that will help investors to keep it simple and yet grow with India, because as a nation, as we keep moving and keep growing, the equity markets will also grow, but not necessarily in a straight line. And the volatility is what probably makes people afraid. The moment markets fall, people want to run away. To avoid that, have a long-term horizon, keep investing, invest in diversified funds as much as possible, so that you are not worried about the volatility which happens in sectors and themes. And in the long run, you should be fine. Thank you.
Abhishek sir?
Chintan has covered most of it. I don't have anything to add. The only thing which I believe one investor should realize is he's saving for a goal, and that goal is definitely a long-term goal. So one should not be worried about what has happened. A lot of clients who exited somewhere in March 2020 when this COVID hit, 21 when the COVID hit, a lot of money came back at a very later stage. People exited at the rock bottom prices, and then they re-entered when the market has already gone up by 40-50%. So at 55,000 Sensex level broadly, I believe majority of so that calendar year, all the AMC's net AM was negative. And the next year, when the market has revived and people have came in, So unless and until somebody had an emergency of funds requirement, you know, for that investor, exiting market makes sense. But don't let this market movement really bother as an investor somebody a lot. Let this market play out, because it is totally dependent in long run on the profit. Till the time our corporates, the listed corporates are making decent profits, they are growing year on year, the market will follow that, probably not in a straight line, but definitely it will copy that over the long run. So and trust me, the kind of economy we are, the kind of demographics we have, the kind of demand which we have, the kind of probably overall geographies in which we our average age, working age is somewhere nearing around 30. We have long way to go, where China is around 40 plus. So we have a long way to grow, and that's why people are looking to India. There's nothing beyond that. Remain invested in this market. India is a great market to be in for at least for next 8 to 10 years. This market will surprise everybody, and that's how most of the people come with their views on it will be a 10 trillion economy and it's a 5 trillion. It's just the maths about how our corporate profitability is going, how we are growing as a GDP. Our nominal growth rate is somewhere around 10 to 12%. Though in budget which keeps on coming at 10.5, and other analyst keeps it at 12, but the trajectory is growth. And thankfully it's a double-digit growth. So people should stick on to long term, as what Chintan was also saying. Do a systematic way of investing. Invest into large companies; those are the best bets. Apart from that, if you have certain surpluses, you can definitely try certain stocks, certain sectors, but keep it limited to 4-5%, 6% kind of allocation, so that any adverse movement may not impact your long-term goal. Yes, it may impact you shortly, but that's where you are taking the bet. But long-term, yes, do a proper asset allocation and move forward. So that's very simple. But people take it complicatedly. That is where I think they need to keep on engaging with the financial advisors, and just to remain intact. Yes, things will pass by.
So I would like to summarize this. Chintan sir and Abhishek sir has mentioned that equity is a long-term game, and have faith in growth of India, and keep investing. Stay invested. So with this, we come to the end of today's episode, Investment Made Easy. Thank you, Chintan sir. Thank you, Abhishek sir. Viewers, we hope you enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at letters@outlookmoney.com. We will be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.